What's up, everyone? It's RJ from The Ways to Wealth. Today I want to share with you a story of what happened after I purchased shares of Tesla at $26 per share. At first this might come off as a little bragging, but trust me, you're going to want to make sure to watch all the way to the end to see what happens. So here's how the story starts. Back in 2012, I bought 190 shares of Tesla when it was valued at just over $26 per share. Today I want to take a few minutes to share some of the lessons that I personally learned from this, stuff that you can take away, and talk about what I learned and translate that to what I feel is the most effective way for you to build wealth through investing. So you ready? All right, let's get to the story. I have a personal rule that says it's okay to make an occasional bet with 5 to 10% of my available investments. So I personally enjoy investing. It's always been a hobby of mine. And thinking about which companies will play a big role in the future is something that I think about a lot. And so this 5 to 10% rule is a way for me to make personal finance fun without gambling my family's retirement savings. So back on August 7, 2012, I placed one of these small bets on Tesla and bought $5,000 worth of stock in the company. And let me tell you what ensued after I placed that order. I know, something I probably won't experience again in my lifetime. I couldn't have timed things better. Looking at the historical price index, that was it was fun to look at what came about. So I'm extremely grateful that I made the decision to invest in this company, but I was surprised at how mentally taxing it was to hold a stock like this during this time. What started out as just this little bet turned into a solid chunk of my net worth. And when you zoom in, there were some price fluctuations, both up and down, I had never experienced. And while the overall trend was up during the time I held, there were downturns as well. When you hold a stock like Tesla, during a period like this, let's be honest, I'm checking it multiple times a day. And there's a behavioral science principle called loss aversion, which says that losses loom larger than gains. And I could say that was definitely the case. Something I remember is experiencing a loss and, it really hurt. It sucked. You go to bed thinking when your stock goes down 20%, thinking about it. And there's this other behavioral science principle called the wealth effect, which says that spending increases when someone's portfolio increases. And this is another thing I remember experiencing as well. I started to justify these little expenses I, probably wouldn't have made otherwise because of this one investment was doing so well. One more behavioral principle that I got to witness firsthand was overconfidence bias. I actually started to think that I had a skill for investing. Maybe it was something that I should do as a career, just from this one investment. Ironically, I had recently taken a deep dive in the field of behavioral finance. So this stuff and these biases weren't new to me, but I was experiencing them for the first time. As I record this, the price of Tesla stock has now exceeded $900 per share. So if you do the math, it turns out really well in my favor. My little $5,000 investment would be worth around $170,000 today. And of course I say would be worth because I sold my shares a long time ago. Of course I sold them. I wasn't cut out to hold a stock like this for the rest of my life. And judging by how frequent investors have been both buying, selling Tesla as well, very few people are to really buy a stock this low and hold. It's a very difficult thing to do. So I ended up holding on for 14 months, cashing out with over 500% ROI. And while I certainly wrestled, currently with a little bit of what is, should have, could have over the years, I'm actually, not that depressed about selling early. After all, if you would have told me 14 months prior to selling, I would have had a 500% ROI on an investment, I would have been thrilled. But the reason I'm not really that disappointed about selling, as you might imagine, is this experience laid a foundation for building wealth and investing for years to come. Today, I want to share those lessons with you, as well as what I feel is the easiest method for you, for me, for anyone to build wealth through investing. Lesson number one, investing in individual stocks requires making two really good decisions: when to buy and when to sell. And you could say both of these decisions take a combination of luck and skill. My purchase of Tesla shares wasn't the result of a deep dive into the company's financial statement. It was more luck than anything else. Let's be honest here. I simply thought that the company was going to be big in the future and invested in it. I wasn't skilled enough to have held the stock long term though. That caused me not to get the maximum return I could have had out of this. Oh, and this is from someone too who has read every single Warren Buffett biography and shareholder letter. He repeats the phrase, "Our favorite holding period is forever." And I remember saying this phrase to other people that I had planned to hold this stock long term. But that's harder in reality. So one day after more major price fluctuations, I decided to put a stop order because I really couldn't take it anymore. A few days later, that stop order triggered when the price declined. And that really taught me a lot. More so, holding a stock as an individual investor is very tough. Say I didn't sell back in October 2013. It's very likely I would have had sold after that. What else is important to realize is that the most of the massive gains Tesla has experienced have come only in the last few months of I record this in early 2020. So that's 7 years difference. And that's a long time. That's a lot of price fluctuations, a lot of ups and downs. So the likelihood that I would have actually had to hold this stock is very unlikely. And the biggest factor is really how my life has changed over that time. I've had 3 kids, 2 moves, career changes, a house renovation, plenty of medical bills. Life events like these play an important role for the smaller investor. Large investors don't really talk about having to, say, liquidate their holdings to pay for medical bills or because they want a house renovation. But for the everyday person, those types of things play a factor in investment returns, especially when it's outside a taxable account. And since the majority of people don't carry a fully funded emergency fund, it's often stocks that get liquidated at inopportune times. So selling at the wrong time is never ideal. And I say this because I hope you're beginning to see what I mean when I say investing is hard. So here's what I like to think of personal finance as this game. The end game is becoming financially independent. There's a couple different definitions, but I define financial independence getting to the point where your income from investments exceeds your expenses. And that means winning the game requires winning over decades, not months or years. So what then is going to help me or anyone for that matter win this game? You got to look at the math, and you have 4 different factors. So how much you make, how much you save, the rate of return, and how much time you let your investments compound. So those are the 4 factors that determine how you build wealth. And a lot of people are shocked by the next thing I'm going to share with you. If you've ever read an investing book, you've probably read a chapter on the power of compound interest. So that chapter probably went something like this. Let's say you are 30 years old making $3,000 a month. You've managed to save and invest 10% of your income. So in this case, that's $300 a month you're saving and investing for the future. It turns out that earning a 7% rate of return, you'll have $153,000 with that by the time you're 50. So that's not bad. That's pretty powerful. But now let's say we managed to earn 9% a year, saving that same $300 a month. We'd have about $193,000 saved up at the age of 50. So this is better. We're getting better, right? But it's here I have to say that beating the market more than 2% a year is rare over the course of decades. It's so rare that there are really only a few people in history to have a track record over 20 years that have outperformed the market consistently. Here's where things get interesting though. So say we increased our savings rate by just 5%. So now we're saving 15% of our total income, which has us saving $150 more a month. And this is something you can't control. And now our investments go back to that same 7%. In this scenario, we'd have $229,000 at the age of 50. Save 20% of our income, we'd have $306,000. So the big thing you don't want to miss here is it's going to be your savings rate that matters most. And that's something that you have control over. You don't have control of the markets, but your savings rate you do. And it's understanding this, and more importantly, putting it into practice over decades, that gives the average person like you and me really a fighting chance to build a good amount of wealth in their life. So keep in mind, a rate of return of 7% is historically about how the market has performed. And investment companies today have even created There's Vanguard and Betterment that have created funds like target retirement accounts or Betterment's goal-based portfolios that basically take care of all the complicated stuff on the investing side for you. So really it comes down to just worrying about your savings rate, piling up as much money as you can in that account. I talk to a lot of young people about investing, and more times than not, they want to talk about what individual stocks they're investing in, or how good an investment they're doing has picked. And since we're in a bull market, that's a pretty popular topic. But that is not something that's going to do them well over the course of decades. So I recently gave this talk at a local meetup about investing for millennials, and in the Q&A, one woman asked me something along the lines of, do you think it's a good idea just to put my money in Vanguard's target retirement fund and really just worry about, saving as much money as I can? That, is really what I want to emphasize here. That's the mindset to have rather than worrying about beating the market by 2%. In fact, if I were to place a bet on who is going to have a larger net worth, a larger nest egg and portfolio, the guy who can't stop talking about how much money he made on this one individual stock investment, or this lady I met at the conference who chooses a very simple investment philosophy but pays attention to how much they invest, I'm choosing that woman every time. In the long run, she is going to have a much larger net worth because she's focusing on what she can control. So that's it for this video. And let me tell you, this was my first one, and really the Ways to Wealth was started back 2016. Over 7 million people have visited the website, which I'm very proud of. And this is my first real video getting it in front of the camera. Let me know how I did. It's fun interacting. I actually enjoyed making this more than I thought. And it's something new for me, and I hope to improve every time. Let me know in the comments below what you thought. I would appreciate if you subscribe to the channel if you like more content like this. And one more favor, if you liked what you heard and agree with this message, press the like button below.